Understanding profitability in cost and financial accounting can feel like navigating a maze, especially when you realize that profit can look different depending on the accounting method used. You might be wondering, why is that? Why do cost accounting and financial accounting show profit in such different lights? Let's break it down together. To start, let's clarify what each type of accounting is all about. Cost accounting is like the behind-the-scenes look at a movie. It digs deep into the costs associated with producing a product or service. This includes everything from raw materials to labor, overhead, and shipping. It's all about understanding how much it truly costs to create something. When calculating profit in cost accounting, you simply take the total revenue and subtract all these costs. It's straightforward, right? On the flip side, we have financial accounting, which is more like the highlight reel of that same movie. It focuses on net income, which includes revenue and expenses, but often leaves out some of those intricate costs that cost accounting tracks. Financial accounting is what you typically see in annual reports and financial statements. It gives a broader picture, but it doesn't always capture the nitty-gritty details that can be crucial for internal decision-making. Now, here's where things get interesting. Because of these different focuses, the profit figures can end up looking quite different. Cost accounting might reveal a lower profit because it's more comprehensive in its cost tracking, while financial accounting might show a higher profit by overlooking some of those indirect costs. This discrepancy can lead to confusion, especially for those trying to assess the overall health of a business. One of the key reasons for these differences comes down to the treatment of costs. Cost accounting considers both direct and indirect costs, everything that goes into making a product. Financial accounting, however, might only focus on direct costs, which can lead to a more inflated profit number. Imagine a bakery. Cost accounting would account for all the ingredients, labor, and even the electricity used in baking, while financial accounting might just look at the flour and sugar. Another layer to this is the way inventory is valued. Cost accounting often uses methods like first in, first out, FIFO, while financial accounting may use last in, first out, LIFO. This can create variances in the reported profit because the cost of goods sold can change dramatically based on which method you choose. It's like choosing different paths in that maze. Each path can lead you to a different exit point. Timeframes also play a significant role. Cost accounting usually looks at a shorter time frame, like a single production cycle, while financial accounting takes a longer view, often spanning a year. This difference can impact how profitability is perceived. If you're only looking at a short cycle, you might miss trends that are evident over a longer period. So, is the profit calculation from cost accounting more meaningful than that from financial accounting? It's a bit of a balancing act. Cost accounting provides a granular level of detail that can help identify areas for improvement, but it can be time-consuming and complex. Financial accounting, while less detailed, is often more straightforward and required by law, making it more accessible to investors and external stakeholders. Speaking of investors, why do they often lean on financial accounting figures if cost accounting seems more complete? The answer lies in compliance and conservatism. Financial accounting is regulated, which gives investors confidence that the numbers are accurate. Plus, financial accounting's more conservative approach to profit calculation can provide a clearer picture of a company's financial health, especially when considering long-term investments. Now, let's talk about the primary users of profitability information. Managers are at the forefront of this. They use profitability insights to make critical decisions about pricing, product mix, and resource allocation. Analysts and investors also heavily rely on this information to evaluate company performance. However, while profitability metrics like gross profit margin and net profit margin are essential, they are just part of the bigger picture. Market share, customer satisfaction, and other factors also come into play when assessing a company's future. So, what do managers do with profitability insights? They use this information to focus their resources effectively, aiming to increase sales and decrease costs. It's about making informed decisions that can directly impact the bottom line. For financial analysts and investors, profitability data helps in comparing companies and making investment choices. It's a crucial tool in deciding where to put their money. Now, let's consider the frequency of profit calculations and insights shared with decision makers. This can vary widely from company to company, but generally, profit calculations are provided regularly, sometimes daily or weekly. This allows managers to stay on top of the business's financial performance and make timely decisions. In contrast, financial statements might be shared quarterly or annually with shareholders and other stakeholders. But here's a thought. Can managers effectively run an organization without regular profit insights? It's a tricky question. In industries with tight profit margins, having up-to-date financial information is critical. A small misstep can lead to significant consequences. However, in industries with more substantial profit margins, managers might navigate without constant insights. The size of the organization also matters. Larger companies often have the resources to track and report finances comprehensively, while smaller businesses may rely on less formal methods. Ultimately, the specific goals of the organization shape how critical these insights are. If a company is focused on aggressive growth or market expansion, regular financial insights are crucial. Conversely, if the goal is to maintain the status quo, managers might operate effectively with less frequent financial updates. So who is responsible for calculating profitability? Typically, this task falls to the finance or accounting department, as it requires a solid understanding of financial concepts and accounting principles. If you're unsure about who handles this in your organization, it's best to ask a supervisor or senior manager for guidance. When it comes to sharing profitability information, there are various methods. Financial statements are the most common way to communicate overall profitability, usually comprising an income statement, balance sheet, and cash flow statement. Additionally, a company's share price can reflect its profitability. A rising share price often signals that investors believe the company is performing well. Return on investment, ROI, is another useful metric, showing how much profit is generated relative to the amount invested. In conclusion, understanding why profit is shown differently in cost accounting and financial accounting is essential for anyone involved in business. Both methods have their strengths and weaknesses, and they provide different insights into a company's financial health. Cost accounting's detailed approach helps managers make informed decisions, while financial accounting offers a broader perspective that is crucial for external stakeholders. Ultimately, it's not about choosing one method over the other, it's about recognizing the value in both. Each type of accounting serves a purpose, and together they create a comprehensive picture of a business's financial landscape. So, whether you're a manager, investor, or just someone curious about the world of accounting, understanding these differences can empower you to make smarter financial decisions.